Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra. Well, asset management company Edelweiss Mutual Fund is scheduled to launch the Gold and Silver Fund of Fund, a fund of funds that will invest in a mix of both gold and silver ETFs. Now, we all know that there are a lot of separate gold and silver investment products already in the market, but this will be India's first scheme that actually offers exposure to both gold and silver via a single fund, and this will be launched on August 24. Now, to join in to discuss what can you really expect from this new scheme, the outlook on gold, silver, and also stock markets? I'm joined by Edelweiss CEO and Managing Director, Radhika Gupta. Radhika, welcome to Business Today TV, and many, many congratulations to you, not just for this fund of funds, but also on becoming a mother to a beautiful baby boy.
Thank you so much. Lovely to be here.
So how have you been? Help us understand, how are you really managing both work and life? Because I hear that you are back to work in full swing just after 6 weeks of having a baby.
Yes, I am. And the days are nice. There are board meetings and there is feeding and, it's a nice mix. I wouldn't say it's a balanced work life, but it's a very enjoyable work life. And I think being a CEO teaches you how to manage time well. So I'm putting time management skills to work.
Absolutely. Well, wish you all the very best and congratulations yet again to you. Now, let's dive right into what we really want to discuss today for all our audiences and viewers, all about the precious metals. So first, talk to us about this new fund of funds. What does it really aim to achieve? How will it really work? How will the ETFs be selected as well?
Sure. So I think this is India's first product that invests in both gold and silver. As you very correctly said, there are gold and silver ETFs out there. This is a combined product. I think the case for gold investing in India is very well known. It's a very popular asset. Incidentally, launch is coming up around festive season as well. But gold is really, I think it serves its purpose because of investment demand. Its use as a precious metal. It's also been a good hedge historically to inflation. It's done well when equity markets have not done well. So that's the case for gold. Silver, I would say, is the mid-cap equivalent. If gold is your large cap, I think silver is your mid-cap in that sense. It has industrial use, it has use in ornaments. It also, what people don't realize, has a use in a lot of new age technology. So even something like a smartphone has a important component of silver. So silver has industrial demand, which is why it tends to be more volatile than gold, but it also tends to do better than gold when commodities do well. So we thought of combining these two as a combined proposition. The fund will invest 50-50 in both gold and silver. So there's no fancy timing out there. It's very, very simple. 50% gold ETFs, 50% silver ETFs. And we really think it will give you a combination of the stability of gold and the upside of silver in a single fund.
Right. So what kind of returns can really investors expect? Those who have not yet invested in any of the ETFs, who will be investing first time, and those who have already got some exposure via separate ETFs, if they also want to look at this exposure again.
So look, historically, and I'll be very honest here, the last 10 years, have not been the best for gold. But even if you look at the combined product over the last 10 years, a 50-50 gold and silver product, the last 5 years, sorry, that's at about 11%. So historically, I think over the long term, the guidance is that gold and silver will give you the kind of returns that equity will, but with significantly less correlation to equity. So there will be years when equity markets do badly, like 2008, where a gold and silver product will shine. But in the long term, I think gold and silver, their 15-year profile has been similar to Nifty TRI returns.
Okay. Also, help us understand, the rationale behind this fund of fund. Why at Edelweiss have you thought of bringing this FOF first, despite not having any separate gold or silver ETF? And for investors, per se, how is it really better for investors looking at bullion exposure to go for a fund of funds vis-a-vis the other gold or silver ETFs?
Sure. So I think, we at Edelweiss have always believed in solutions and simplifying life. I always tell investors, how many schemes can you have in your portfolio? How many decisions can you make? I mean, working life, I know I have a busy working life. We did a product very similar to this in the equity space called a large and mid-cap index fund, where we did 50-50 large and mid-cap, and that was very well received. The idea here was that if you wanted to have a commodity allocation, and I always believe people people should have a 5 to 10% exposure to an asset class like this.
Yeah.
There's a single product that solves it. You don't need to time gold, you don't need to time silver, you don't need to rebalance, you don't need to worry about tax. It's all done for you. You can start an SIP into it, and it's all there. So yes, people can invest in individual ETFs. We just thought we would combine them into a single package solution. I think there is something called bundling innovation, which is what this is. I personally intend to do some allocation into this one or start an SIP into it, just because it's very, very simple. And, we'll invest in the best in class industry ETFs. If we choose to launch one later, we could also do that. But the industry has great gold and silver ETFs that we can use.
Okay, so help us understand about the timing of this fund launch. Like you pointed out, that gold has not, the last 10 years have not been the great for gold prices. Right now, if we see about the near term, gold prices are hovering near a month's low. Also, when many believe that inflation is peaking out, do you really believe this is the right time that one must look at investing in gold and silver via mutual funds?
Yeah, so I think there are two parts to the timing question. One, of course, is that when we launch funds, we do look at the long-term case because timing is very hard to get right. That said, of course, at Edelweiss, we also try to make sure the timing is at least reasonable. No one can get timing right. One thing that is interesting to note is that the performance of gold and silver is sort of negatively correlated to the dollar index. And with all that's going on in the US, the potential recession that you could see in the US economy, with what's happening in the dollar index, this might be a point of turnaround in gold and silver. So historically, when an asset class has not performed and the macros are sort of supportive, it makes for an interesting case for a launch.
Okay. Now, just like how you also pointed out very interestingly, that traditionally we've seen gold as an inflation hedge, a hedge against other uncertainties. But this year, despite these, all of us seeing the war, the high inflation, gold has really not performed that much. What could be the reasons for this? And do you believe, as many critics point out, is gold really losing its value as a hedge against uncertainties?
No, I think gold's status, and over the last few years, people have challenged gold's status as a reserve currency, particularly with things like crypto coming in. I think this year has validated that, that doesn't exist. I think in really sharp equity corrections, I think gold has done well. This year may be an aberration, but I don't think gold's status as an inflation hedge in itself goes away.
Okay. Like you also said that, you believe that a 5-10% of one's core portfolio should go into gold and silver investment. I want to understand this in the context of millennials. Like in today's age, millennials have, beyond stock markets, they have cryptos, they have REITs, InvITs, they have NFTs, they have Web3, even startups and metaverse to look at. So many new investment avenues. Do you believe the traditional gold investment has that much interest? And should it be a part of a millennial core investment portfolio as well?
I get this question a lot, and incidentally, by the way, I am a millennial, even though I don't think I'm a millennial, but I am a late-end millennial. I think your core portfolio should be simple, and I think whether you're a millennial or whether you're a 60-year-old investor, there are what I always call basic dal chawal components to your portfolio, and those are good quality fixed income, those are good quality equity, and those are a little bit of, gold/silver commodity allocation. I think these are basic core investments that have stood the test of time. 80% of your portfolio genuinely should be this. 20% can be lots of fun stuff. My opinion on crypto I'll reserve for another day, but 20% can be thematic ideas, capital, all of that if you understand the risk. But I don't believe core investments go out of fashion. Perhaps the appeal to a millennial will take some time. We're also, I think, as a mutual fund industry, I'm also vice chairman of AMFI. We have to keep finding ways to make sure we can make simple products still appeal to a new consumer base. So that's a constant challenge. We're trying to do some interesting marketing with this fund. So let's see how that goes.
Okay. Now, you also said very interestingly that historically precious metals we've also seen have an inverse correlation with, say, the dollar. And currently we are actually seeing the rising dollar index. And then there is the Fed rate hike worries. Do you believe that these could definitely pose a headwind for gold prices going forward? Can they correct more from here? What is your outlook on gold and silver going forward?
No, we actually see that. I think, with what's happening in the US, you could have the dollar index move downwards, and if that is the case, then perhaps there is a case for gold and silver. So with potential recessionary pressures, and it's a little early to speak. This may be a possible catalyst.
Okay, but can the festive season bring cheer? Like you also said that, you're hoping for the festive season to change things for gold investors and for gold prices too.
So look, I think you have to look at large supply and demand dynamics. I don't think the festive season will bring enough cheers, or I don't think the festive season should be a reason to look at the product. I again and again say that I think investments should be long term. So I don't think a single month or a single event it should be a catalyst.
But your outlook, say in case, because you've launched this fund of fund right now, you're launching it like on 24th. You have a long-term view here. Say 5 years, 10 years down the line, where do you see gold and silver prices moving?
I expect that you should see, I hark back to the long term, to see a 10% plus compounding in gold and silver prices, which is in line with equity market compounding or, large cap equity compounding. I think that is a reasonable outlook to have.
Okay, let me get you to answer some queries on markets as well, because having you here and not asking you about markets does not go very well. So stock markets right now, they're feeling the heat. Many believe they are correcting because we may be in an overbought zone. We've seen a sharp rally in the last 2 months or so. What is your outlook on markets? How are you looking at texture like right now? Is the market in for a long pause from here? Can we see deeper corrections, or will there be a pullback?
So our belief, and I think we said this at the end of 2021, that this year, this calendar year, would probably be one of two halves. One would be an extremely volatile first half, and even then, I don't think we bargained for the kind of volatility we saw. But there was a lot of uncertainty. There was geopolitical uncertainty. There was when will the Fed rate hike taper? There was uncertainty around that. There was inflation, so we saw that. I think the second half of the year, and again, 5% correction, 10% rally, it is very hard to comment on that. Nobody does a great job of predicting markets. Could the year be a little more stable than it was this half of the year? Perhaps that is our belief. I think what you're seeing in the US and in India is that at least you have some predictability on where you are in the interest rate cycle. In India, our belief is that rates are now about starting to peak. So that large element of uncertainty that loomed in the first half of the year, I think, is coming down. I think the other positive is that corporate earnings, particularly financials and consumption, have been positive. And we certainly see that consumption demand is back and back with a bang. So, bouts of, small bouts of volatility, small corrections after a 10% odd rally in, markets, are part of the course in equity investing. But we do see some of the uncertainty factor has come down.
So at this point in time, what are you really advising clients and investors? Should one become cautious because of this volatility, or should one really load up more stocks whenever they see dips? What is your strategy like?
So our approach has always been one to favor asset allocation. It's a very, very boring answer, but it has been an answer that has served clients well in the last couple of years. On the equity side, a flexi cap or a multi cap asset allocation. For conservative investors, I would say one thing: there were a lot of millennial and new investors who came into the market in 2021. What they saw in the first half of this year was probably their first bout of volatility or correction. For those investors who over allocated and perhaps rediscovered, because I always believe risk appetite is really understood in your corrections. For them, perhaps it's a time to reassess now that things are calmer, if they want to take some money off the table. And I think you'll see that in the industry data as well. You will see a little more redemption pressure as people take money off the table. I don't think that's a bad thing. So for those investors, if you have to take money off the table because you over allocated to mid cap or small cap, perhaps you should do that. That's also not a bad thing. But I think the key message is stick to your asset allocation. If you over allocate it, perhaps you can rebalance.
Right. So at this point in time, how are you looking at, where are you looking to buy stocks? I mean, is it going to be in all various categories of market capitalizations? Is it going to be large caps? How are you picking the stocks right now? Your month, if you could say.
So we run, multiple fund mandates, and of course we run diversified funds. I think themes that we have been bullish on are manufacturing in India, beneficiaries of PLI. We have been very bullish on industrials as a segment in our funds, perhaps more than our peers. And over the last couple of months, we've added some energy to our financials positions as that segment sees a turnaround. So while we run diversified funds, I think these are a couple of segments of opportunity, particularly industrials, that we've looked at in our funds.
And what do you think about autos, which have actually hogged the limelight over the last few months?
Okay, so we haven't gotten, we don't have large overweight positions in autos. I think it's wait and watch.
Okay. Also, your comment on the new age listed players, because we've seen a very, very volatile year for most of them. Your thoughts over here, are things turning for the better for some of them?
So, we run both a recently listed IPO fund, and we also are in the process of fundraising for a late stage private equity fund. So we see this segment very closely. I would repeat what we said last year. We were very judicious in how we look at opportunities in newly listed companies. Certainly, there are good pockets, and what we see even on the private side when we're raising our private equity fund and looking at deals is that valuations are correcting, expectations are becoming a little more modest. Entrepreneurs are, of course, talking a lot more about sustainability and profitability, and there is an impact on new listings that are coming up. So the pipeline of new listings has slowed down, but that doesn't mean it's going to stop. I think good businesses will always find value. I can give you an example of a consumer products company that had a very tepid listing sometime in December, but has done extremely well post listing. So I don't think listing is a be all and end all. I think the idea is to identify good businesses. Good businesses will come to market in an economy like India, where many businesses are not even represented in the listed markets. Good businesses will continue to come to market, but the key is to be judicious. And yes, if some of the froth cools off, that's a very good thing.
Right. But, just to clarify to all our viewers at this point in time, how do you really identify, what are the points to identify these good business among the new age digital businesses? Because traditionally, we've seen at balance sheets, we've seen at profits, but here the profitability is not the judging point. So how does one really pick and choose?
A couple of things. One is, of course, unit economics. Look, profitability is a hard thing to find in many of these businesses, although you find listed businesses that are profitable. All newly listed businesses are not new age, fintech, etc. But we really look for solid unit economics. We look for industries where there is an opportunity. Finally, a business is one that is able to sell a product to a consumer and make money doing so. So we look for unit economics. We look for growing industries and growing market share. We pay attention to management and their ability to get the aspects of governance right. I think that is a factor that takes a lot of new age businesses down, because you're recently listed, you come into the market, and then you start doing things. You tell one story on listing, you're telling another story after listing. So we pay very close attention to what management is saying into elements of governance. How are you going to treat minority shareholders? And I would say for retail investors, this is a hard thing to do. DRHPs are 400-500 pages long, which is why we launched a fund around this. So trying to do due diligence here, it is tough. This is not like understanding a large cap company. So people should keep that in mind.
Understood that. Well, thank you so much for all those insights, Radhika. It's been a pleasure, as is always, speaking with you, and all the very best for this new fund of funds.
If you like the video, do like, comment, share, and subscribe.